Excuse me, everyone. We now have all of our speakers in conference. Please be aware that each of your lines is currently in a listen-only mode. At the conclusion of today's presentation, we will open the floor for questions. At that time, instructions will be provided as to the procedure to follow if you would like to ask a question. It is now my pleasure to turn the conference over to Mr. Richard Cribbs.
Hey, thanks, Brad. Good morning. Welcome to our fourth quarter conference call. Joining me on the call this morning are David Parker and Joey Hogan. This conference call will contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. Forward-looking statements are subject to risks and uncertainties that could cause actual results to differ materially from those contemplated by the forward-looking statements. Please review our disclosures and filings with the SEC, including without limitation the risk factor section in our most recent Form 10-K and our current year Form 10-Qs. We undertake no obligation to update or revise any forward-looking statements to reflect subsequent events or circumstances. As a reminder, a copy of our prepared comments and additional financial information is available on our website at covenanttransport.com under the Investors tab. Our prepared comments will be brief, and then we will open up the call for questions. In summary, the key highlights of the quarter were our truckload segment's revenue, excluding fuel, decreased 13.4% to $152.8 million, due primarily to a 10.4% decrease in average freight revenue per truck, along with a 105 or 3.4% average truck decrease in the 2019 period as compared to the 2018 period. Versus the year-ago period, average freight revenue per total mile was down 24.2 cents or 11.3%, while average miles per tractor was up 1.1%. A portion of the reduction in freight revenue per total mile was planned as we have steadily increased the percentage of our assets allocated to dedicated truckload or other year-round service offerings, leaving a smaller percentage to participate in the more volatile peak season, which secures significantly higher rates for a few weeks. The other primary factors impacting the decreased average freight revenue per total mile were continued capacity and demand imbalance and a reduction in certain of our customers' peak season team capacity needs this year. The main factor impacting the increased utilization was an improved average seated truck percentage, as only 1.5% of our operational truck fleet lacked drivers compared with 3% during the prior year quarter. The truckload segment's operating cost per mile, net of surcharge revenue, was down approximately 3.3 cents compared to the year-ago period. This was mainly attributable to lower employee wages and group health claims costs, partially offset by higher net fuel expense, workers' comp claims costs, and outside professional advisory fees. Our managed freight segment's revenue, excluding fuel, decreased 15.5% versus the year-ago quarter to $57 million from $67.5 million. The primary factor to this reduced revenue was a reduction in certain of our brokerage customers' peak season capacity needs this year. Due primarily to the bankruptcy of one of Transport Enterprise Leasing's that we call TEL's customers, our consolidated net income included a $400,000 pass-through loss, or 2 cents per diluted share, from our minority equity investment in TEL, compared to the inclusion of a $1.7 million pass-through gain, or 9 cents per diluted share, in the fourth quarter of 2018. The average age of our tractor fleet continues to be young at 2 years as of the end of 2019, down from 2.2 years as of the end of 2018. During the fourth quarter, we took delivery of 47 new tractors and disposed of 256 used tractors, and at December 31st had approximately 625 tractors, the excess tractors, removed from our operating fleet that are either in the process of being prepared or have already been prepared and are held for sale. We expect to dispose of most of the excess tractor units in the first half of 2020. Between December 31st, 2018 and December 31st, 2019, total lease-adjusted indebtedness, net of cash, increased by approximately $50 million to $304.6 million. At December 31st, 2019, our stockholders' equity was $350.1 million for a ratio of net lease-adjusted indebtedness to total cap of 46.5%, compared to a 42.6% ratio as of December 31st, 2018. In addition, our leverage ratio has increased to 2.4 times from 1.5 times a year ago. The main positives in the fourth quarter were, one, consistent profitability from our land air dedicated truckload and managed freight businesses in a difficult freight economy. Two, decreased truckload operating costs on a per mile basis. And 3, a $24.2 million quarterly decrease in our net lease adjusted indebtedness. The main negatives in the quarter were 1, the pass-through loss from our investment in TEL, 2, the 10.4% year-over-year decrease in average freight revenue per truck for our truckload segment, and 3, the operating margin declines of our expedited and solo refrigerated service offerings on a year-over-year basis, and 4, the large amount of excess non-operating equipment at year-end that results in higher indebtedness and related expense until sales proceeds are realized. Our operational fleet size experienced an increase to 3,021 by the end of December, a small 13-truck increase from our reported fleet size of 3,008 trucks at the end of September. From a financial perspective, we expect operating cash flows and our leverage ratio to improve for fiscal 2020 compared with fiscal 2019. We expect financial improvements to be weighted toward the second half of the year as year-over-year comparisons in consolidated average freight revenue per total mile and margin performance in certain irregular route truckload operations are expected to be negative for at least the next several months. Our expectations for improving performance throughout 2020 are based on assumptions of declining truckload industry capacity due to, among other factors, a continuation of falling new truck production, competitors exiting the industry, and tighter federal drug testing regulations. 2, continued U.S. economic expansion. 3, the successful disposal of excess real estate and revenue equipment. And 4, the reallocation of assets to more profitable operations. The timing and magnitude of these factors will impact our results. For 2020, we are intensely focused on accelerating our plans to become embedded in our customers' supply chains, reduce the cyclicality and seasonality of our financial results through growth in our higher margin yet less volatile services, and to enhance sustainable long-term earnings power and return on invested capital for our shareholders through disciplined strategic planning and execution. Our operational focus areas are as follows. In our truckload operations, we are seeking to tighten our one-way irregular route truckload freight network to reallocate capacity from solo-driven refrigerated to more profitable dedicated and dry van opportunities, to decrease real estate and revenue equipment capital costs per mile, and to reduce other controllable costs. Regarding the dedicated truckload service offering, we have recently been awarded significant new long-term business that is scheduled to be operational beginning within the second quarter of 2020. In our managed freight operations, we have attained excellent customer retention rates in our more profitable warehousing, transportation management, and factoring service offerings. We expect continued growth with these customers as well as with new customer opportunities. We have a strong sales pipeline in these offerings for which we have targeted growth and have already secured some long-term awards for our warehousing services that are scheduled to begin late in the first quarter or during the second quarter of 2020. From a balance sheet perspective, with net CapEx scheduled well below normal replacement cycle, along with positive operating cash flows, we expect to reduce net lease adjusted indebtedness over the course of fiscal 2020. Thank you for your time, and we will now open up the call for any questions.
Thank you. At this time, we will open the floor for questions. If you would like to ask a question, please press the star key followed by the 1 key on your touch-tone phone now. If at any time you would like to remove yourself from the questioning queue, press star 2. And again, to ask a question, please press star 1. We'll take our first question from Scott Group of Wolfe Research.
Hey, thanks. Morning, guys. Can you talk about what you're seeing so far in January from a demand and capacity standpoint, and then also utilization was up a little bit in the fourth quarter, what your expectations are for utilization here in the first quarter?
Hey, Scott, this is David. I definitely feel like that, for the first 23 days of January, that a big piece of our business is up over the same time 12 months ago. And so that's very encouraging. Now, keep in mind that as you think about utilization, we're growing the dedicated side, continue to grow it pretty fast. So you got some of those accounts, as you know, are 185 miles length of haul, and they don't run a whole lot of miles. So, just to look, and I was thrilled with the 1% increase in utilization, in particular with a lot of the shorter length of haul dedicated business. So, that's probably not going to be a good measurement. It's there, and it's a measurement, but, it's not going to give us a fair measurement of what's going on with our business as we continue to grow the dedicated side. So as I just look at in particular, the expedited side on the highway services, the expedited side, I'm very pleased with the beginning of this year for the 3 weeks. I'm definitely seeing an uptick in that business, and so that's good. The solo refrigerated side, the southwest region of the country was pretty solid, but other than that, I'm not happy. It's one of the reasons why we're starting to devote a lot of that, some of that equipment to dedicated as well as to the dry van operation, and we're gonna figure out on the reefer side what is solid for us, and that's where the reefers are going to go. And other than that, we're going to convert some of that to the dry van. So the expedited side, which is again on the highway services, is right now at 60% or so of that business. For the month of January, in terms of getting better, I'm pleased with.
Yeah, and Scott, I'll add, I think the first quarter we're kind of looking at being up a little more than what we were up Q4 on a year-over-year basis. So kind of in that 2 to 3% year-over-year range of increase in utilization from first quarter of last year. That would still be down 2 to 3% from Q4.
Okay, helpful. And then maybe what are you seeing right now from a pricing standpoint? How are the early 2020 bids coming in? And then I think rates were down 11% year over year, fourth quarter. How are you thinking about first quarter?
I think the best way to look at it is that I do believe in the last couple of quarters that rates have bottomed from, again, on the highway services side of the business, because the dedicated is pretty solid, and it's not, the customers look at that in a different light. So that side of the business really does not concern me that much. It's the highway services is probably the main thing that concerns me, and probably the question that you're asking there. And I think it's bottomed out, but I can't tell you that the rates have started going up, because one of the things that we're doing is keeping the business that we've got, and at the present time, not asking for rate increases on that business until the market allows us to. And then on the new business, we're just going after new business. And if that means that my rates are 2 cents a mile cheaper than what I want to haul it for, then it's going to be 2 cents a mile cheaper. So new business coming on is not where, it's not where I exactly want it at, but the existing business that's out there, it's flat. I think that we still got, because there's no doubt in my mind that capacity is leaving the market, that we've all seen for the last, 6 to 8 months, that is leaving, and I think it's even going to leave a little bit faster. So we're not being bombarded by our customers for decreases overall, and so that's the best sign. 12 months ago, 10 months ago, we were being bombarded. The whole industry was about pressure on the rate standpoint. That is not there anymore. So that part is good. So that's what I think about it.
Yeah, Scott, in the third quarter, rates were down about 5 to 5.5%, and they were probably down 5.5 to 6% on a core basis, non-peak customer basis in Q4. And so I think as you look at kind of first quarter, like David said, there hadn't been a whole lot of change from customer contracts, and so it should still be down year over year, but not at that 11-12% pace that we saw in the fourth quarter. That was really due to the peak customer freight. And on the dedicated side of truckload, we've also been able to get a handful of increases on some customers that were underperforming that we really needed to have at least something on to make that worthwhile to continue doing. And so there's a little bit of offset to the underwhelming pricing on the irregular route side.
Okay, and then just last question, maybe Richard, if you can help with some guidance. I'm guessing first quarter is unlikely to be profitable, but any thoughts there? And then when you think about full year, do you think we can see full year margin expansion? Do you think we have contraction? And then maybe same question on earnings. Do you have any line of sight to growing full year earnings, or do you think it's likely that earnings are for the full year down?
Well, there's obviously a lot of wild cards, economy and the presidential race and those type things. I think we aren't expecting to be able to be profitable in the first quarter. Possible, not probably likely. For the full year, because we had a good first half last year comparatively, it's going to be have to be caught up in the second half of the year in order to get back to equal to what we performed this year or better. And depending on how tight the market gets, that's still possible in our eyes that we could beat this year's results. But there's a lot of wild cards.
Understood. Okay. Thank you for the time, guys.
Thank you.
Thanks, Carl.
Our next question comes from Jack Atkins with Stephens Inc.
Good morning, guys. Thanks for taking my questions.
Hey, Jack.
David, if I could just go back to your comments on the market, and I just kind of want to, if you could, maybe expand a little bit on it, just in terms of how you think that maybe the next 3 to 6 months play out, because it does seem like the capacity attrition that we've all been kind of talking about the last couple of quarters is starting to build, and the market definitely seems more balanced today than it did, call it 3 months ago. And you're talking about a shift in sort of your customers' expectations around price on the margin. Could you just kind of comment around, as we kind of get into March, April, May, I mean, how quickly could this market turn, in your opinion?
Jack, one of the things before we got on this call that I told this management group up here is that I just got back last night from 3 days in Chicago. Saw 11 customers among all of our segments, expedited and brokerage as well as dedicated, and for 3 days. And if we had a month or so of what I had for three days, this thing would be back pretty strong. I would be thrilled. And so those were the best 3 days that I've had in 14 months. I've been in depression for 12 months now, since January last year, and I was very excited for the last 3 days. Every meeting that I went to was great opportunities new opportunities that I am 90% sure that we're going to hit some home runs on these accounts. And that's just, it's kind of one of those things that you got to crawl before you walk, and you got to see some sign of life before it starts coming back. And that's, David Parker personally, besides our sales teams, that's the first that I have experienced this year was the last 3 days, and I was excited about what I felt the last 3 days.
Okay, that's encouraging. That's encouraging to hear. Shifting gears here for a minute, and I guess this question's for any of you guys, but just would be curious if you could expand a bit on the managed services pipeline and the recent wins there, and I guess as you guys are thinking about the opportunity set, the revenue potential for that business in 2020. Could you maybe kind of help us put some brackets around that, and if there are any sort of startup costs associated with those new contracts?
Hey, Jack, it's Joey. The way that I would kind of try to simply answer that, and this includes dedicated, because we look at dedicated with our managed freight together, so it's kind of our logistics group. So we've got 5 startups in the next 4 months that are pretty significant. And that, the management team's doing a great job of building startup plans for those, but we've never done that before. And that's a significant challenge for us that I'm very proud of how the whole enterprise is working together, including the shared services team to support those startups. So it's significant. I'm going to say 40 to 60. I'm getting adjusted here. I'm going to say 50 to 60 million of annualized opportunity, for those. That's huge. That's huge. And so, but we got to bring them across the goal line. We got to get them assimilated. We got to have a 90-day. We got to be great. First 90 days, that first QBR after each of those is critical. So of those 5, two dedicated, 1 managed freight, and 2 warehouse is the pieces of those. And so that's neat because it's kind of spread out across that kind of logistics offering. I did see, I would say, kind of piggyback on what David said on the highway or one-way side. Went through it pretty in detail this morning, and it's exciting there also. Now you got to get them across the goal line. Is it because of all the capacity that David alluded to that's starting to leave the marketplace? I mean, we started seeing that just with some data that we tracked last summer. But there's a lot of things going on that's affecting capacity. I think a key sign will be when the spot market stabilize, and I think it's stabilizing now. It's just my opinion. Could it be up and down, a day or a week at a time? But yes, that's a sign of capacity. And then obviously when it starts to tighten, that's when spot moves and then contract will move with that. But I agree with David. I saw a few customers earlier in the week. There's still what I would call some soft ask going on out there. But generally speaking, and these are some large shippers and customers that we have. I think everybody's starting to see it, but I'm excited on the highway side too. Some of the things that we're seeing there also.
Okay, that's great. And then kind of shifting gears back to sort of the bigger picture on 2020 for a moment. When we think about 2020, a lot of the discussions have been on the capacity front and the potential for supply to come out of the market. But, I guess one of the interesting things to me is the demand comps are pretty easy in 2020 versus 2019. You have an extra day in the first quarter with leap year. You've got a more favorable holiday calendar and timing in the fourth quarter. When you kind of think about the opportunity in 2020 versus 2019, I know the first half comps are tough just from an earnings perspective, but just when you think about how the calendar shakes out, is that maybe something in the positive category for you guys as you think about this year?
I mean, I agree.
It does. I think the key, a key, it was brought up earlier, is that all the pricing moves throughout 2019. First half comps for pricing are going to be very difficult, and so until you get past that, to have the full year effect of those. And so that's a headwind. That's a pretty heavy headwind as we comp versus a year ago.
Sure.
And I think that's just something that there's several things that Richard mentioned. The equipment that's been huge, both for CVTI or the operating company as well as TEL. And there's just a significant amount of equipment and capital that we're very confident that we've got good plans on moving those. But it's been a huge earnings drain that we've got to push through the system, and that'll take a while. It's going to take every bit of the first half to get a large chunk of that out of the system and get paid for. So, or getting revenue generating on some of it on the tail side. So, those are two kind of big headwinds. When you what I would call comp a year ago, that's just the market. They're going to have to push through it and get through this bid season.
Okay, that's helpful, guys. I'll hand it over. Thanks very much for the time.
Thanks, sure.
Thank you. Our next question comes from Jason Idle with Cowen.
Hey, Jason.
Hey, guys. Good morning. How are you?
Hey, Jason.
A couple quick things. One, Richard, I just want to make sure I heard what you said earlier about tractors held for sale. You said there was 625 being held for sale in prep?
Well, I don't use that term because that's an official accounting term, but there's 625 that are either being prepped for sale or are held for sale that are excess at the end of December. That number was over 800 at the end of third quarter, and we should run those 600 through the system and get them out by the end of June.
Okay, some of those that we sell and some we trade in.
Yeah, and probably about 60% of those are sold back to the OEM, and then about 40% of those will be sold outright to the market.
Okay, perfect.
But we feel good about the book values on those, et cetera. So.
Okay. You think about fleet growth from here. You said you ended the quarter at 3021. Is this going to basically remain flat as we move throughout the year? Do you see it growing any, maybe in the second half if things improve?
Yeah, fleet. Yeah.
The fleet size at the end of the quarter was 3,021. I think what we'll have is a little bit of decrease over the first half of the year as we do a few things, as we move trucks, as we get new customers on the solo drive-in side, as we move to dedicated from the solo refrigerated side. So there's partly that, and then in addition, some of those dedicated accounts start, second quarter, and we'll start seeing that pick back up. But there's also some dedicated accounts that if we can't get them to the profitability levels that we want, then they may be culled out. And so there's a piece of that could happen where the truck count could decrease for that in the first half of the year as we're really evaluating the profitability of each of those accounts. So between those things, I think it probably goes down a little bit, maybe down 50 by the end of the first half, and then starts picking back up by the end of the year.
Okay, that's great. Also, the charge in Cal for the CGI bankruptcy, is that all done, or are we going to see more drain in 1Q?
So there will be some pullover into the first quarter and a little bit in the second quarter as several of that equipment that we've already taken back has not yet been redeployed or sold. So there's a piece of that where we'll continue to have depreciation and interest, where they will have additional depreciation and interest expense and no revenues to offset that. So I believe that they will be profitable in the first quarter, but only slightly, not up to the kind of numbers they were producing in the first 3 quarters of 2019. And then in the second quarter, that improved closer to that old mark. And then in the back half of the year, I expect them to be back to running very close to what they did in the first 3 quarters of this year, of the 19 year.
Okay, perfect. Gentlemen, my last question before I turn it over to somebody else. You talked about, obviously, the 5 new startups, 2 dedicated, 2 warehouse, 1 managed freight, 50, 60 in annualized revenue, I think, Joey, you said. How should we think about that as it flows through your income statement? Is this, 50 to 60, you're confident you'll have that in 2021, and this will just build as we move throughout this year? How should we do that?
Yes, it'll build throughout this year. Those are annualized. And again, Richard said it also. There could be some offsets to that, depending on, customer receptivity, especially on the dedicated side and the highway side, frankly, to pricing, the existing business. So there could be some deducts, but if you just focus on the startups, it'll build throughout the year, and it will take. Most of that is coming on in the second quarter, early to late second quarter. So third quarter will be a good proxy to see the full kind of annualized effect in the third quarter.
Okay, fair enough. Gentlemen, thank you so much for your time as always.
Thank you.
Thank you. And again, ladies and gentlemen, to ask a question, please press star 1. We'll take our next question from David Ross of Stifel.
Yes, good morning, gentlemen. Just to follow up on the 5 startups in the next 4 months, should that be a near-term headwind to EPS in 1Q and 2Q as you incur costs before the revenues start coming in? And is it significant more in one or the other quarter?
Yeah, the first quarter will have more of that. On the warehousing side, there's some technology startup costs, and then on the dedicated side, as we kind of move trucks around to the new locations, so there'll be a little bit of a headwind there in the first quarter, maybe some in the early second quarter, but for the most part, that'll be done by June.
And then, Richard, maybe I missed it because you talked in a release about net CapEx being well below normal replacement cycle, but I didn't see a range. Is 50 to 60 million a good range, or how are you thinking about that?
I think it'll be lower than that. Didn't put it in the release, but I think probably a $20 to $30 million net CapEx number for next year is likely, especially given that we've got 2 pieces of real estate that we're selling that are up for sale, and we have some good prospects for selling those, and hopefully we'll be able to get those done by March, or if not by March, by the end of the second quarter.
And David, you mentioned that you were very pleased with expedited business year to date. How would you, I guess, characterize the drivers of that demand? Would that be on the e-commerce side, on the LTL side, or is there something else going on in expedited that's making you happy there?
Yeah, no, it is. I can't say that the LTL side, we brought on a couple of more. Of course, we do so much with a lot of LTLs, as you already know, but we have brought on a couple of new ones. We got one in particular that's really on existing business that's really been growing in the last 3 or 4 months. And we brought on a couple more, but it's really across the board of new opportunities that are out there that are existing for us. And some of the air freight side that, they're doing their best to put as much as they can on the road, that we've been able to bring on a couple of those. But the expedited side is just, I've been encouraged about it. And so that's the best way to explain it. It's really across the board. I mean, I see retail, good opportunities. They're existing now. Again, some air consolidation customers that's existing now. A good medical piece of business that is coming on board with us. So, yeah, it's really across.
And then last question, Richard, around the operating tractor count. The fleet's expected to be, flat or down up to a couple percent by the end of this year. How would you break that out between what the dedicated fleet should look like and what the rest of the fleet should look like? Would it be dedicated up 3%, the rest of the fleet down 3 to 5, or how do you think about that?
Well, kind of as a percentage, looking at averages for 19 versus 20, I think that the average of the dedicated average of our total truck count is going to move up probably by the end of the year, closer to something like, or let's just say for the average of 20, it'll be closer to 59 to 60% from 54% this year. And then on the expedited side, I think that'll stay about the same, which will make it a little higher percentage if our truck count decreases. And then the solo reefer side that averaged closer to 400 or so trucks this past year at 19, I believe that'll be down to probably 200 by the end of the year, and will be replaced with some of that goes to dedicated and some of that goes to one-way or regular route dry van solo. So that's kind of how it should break down.
There's a lot of
Thank you very much.
Right. Dave, there's a lot of moving parts within that, Dave. One of the things after we purchased the Land Air acquisition and all the dedicateds coming under John Tweed, one of the things that we've been working diligently on for the last 8 months is individual P&L statements by every dedicated, because we've grown it dramatically in the last year and a half, and we're about, guys, 99% through that. Is that a good number? 95%. I mean, we're at the tail end of having crystal clear numbers by account instead of just averaging the dedicated. And what I mean by that, if we got some that got insurance at 15 cents a mile and some at 10, instead of having it at 12 across, we're going to know exactly that it's 15 and 12, and we can deal with that. And so we're about 95% through that, and I know we'll be there in the first quarter that we will know exactly. Now, what is my gut? There's 1,700 trucks there. My gut says that there's probably 150, might be 200 trucks that one of two things will happen. Either we will exit it or we will go to the customer first and we will get price increases to offset and to make those things acceptable. I'm guessing that 50% of those will, that the customers will give us what we need on that. It's what my gut is telling me. We also have got about 200 trucks in the highway services that Richard was talking about there that, you know, our goal with us today or 6 months from now is to put it into the dedicated side of the business. So depending upon how many trucks we got to replace because the customers will not give us what we need on that dedicated is 150 or 200, I could draw a picture that there could be 300 trucks in the network that we want to get into dedicated. Now, I'm very happy you heard a little bit. The pipeline's pretty good. And it's growing. I'm pretty excited about the pipeline that we have got. And I'm here to tell you, we got three that we're working on that if we hit one or two of them, I mean, they're big. They're big operations that could take care of my problem pretty quickly. So that, to give you a flavor, hopefully that gives you a flavor of, you know, the trucks are moving around. And I think in the next few months they will get to where, you know, going forward we'll have them again. And with the financial picture on the dedicated side of the business being something that we all will be happy with.
Thank you. And we'll take our next question from Nick Fairwell of Arbor Group.
David, good morning. Just a quick update, if you wouldn't mind profiling the improvement in expedited, just generally by regions and lanes, and comment a little bit about the stability of that business in January. And does it have anything to do you think, with especially relative to rail traffic, that maybe you're gaining share versus rail again for some reason?
Yeah, there is no doubt that a little bit of what intermodal has done, you know, on their precision tracking and right, doing what they're doing there is definitely taken some freight off of rail in the last year and a half, and it's gone some OTR. So depending upon where the origin is at, depends upon if that is made available. So even though I don't have anything concrete that says I know I took that off intermodal, I know there's some that has done that, especially on the LTL side of the world, that, you know, is happening, that's been happening there. Another thing that is happening is that, you know, for a lot of the carriers out there, you know, that are competing with same-day delivery, quote, Amazon is leading that, but all the other retailers are following suit. So they're all doing it. On the retail side is that a lot of that is becoming, as you're reading about it, it's true, that, you know, 6 and 7 day delivery from 5-day delivery, and the only way that can happen is through a lot of that being the expedited side. So we're sensing, you heard me mention a little bit ago that in particular existing customer that we got that we've really grown with in the last 5 or 6 months is because they've taken their network and they're going to 7-day delivery to make sure that they're competing. And so we're also seeing some of that on the expedited. You know, one of the things that we've been talking about, say, for the last couple of years, and one of the reasons why we started going on the dedicated side of the world, as well as the purchase of land there, almost be 2 years in July. But, you know, one of the things that we all know about the expedited side, the expedited, love it. It's our heritage. It's what I started the company with. Those are all positives. What's the negative on the expedited is that it can be volatile. And we know that. We've seen that ever since we've been public or ever since I've been in business, is that model absolutely goes from 85 to 95. And ORs. And whether that's in the first quarter, whether that's snow on the ground, and I got two people and there's a higher cost, and the truck can't run like a third shift manufacturing like that that expedited needs to, that hinders it. Now, the positive side is that when things are going well, freight's good, and the weather is good, and that thing is pumping in the low 80s. And so that's what the model is. So we decided 2 years ago, there's no tell that the value of that expedited is tremendous, no doubt. 900 teams, that run in that expedited division is something that the market absolutely needs. But how do you deal with the volatility? And our question is our answer to that question is to continue to get deeper in the supply chain and go into more of the dedicated side of the business, as well as managed services there and warehousing, and that's what you're seeing us perform. So you're seeing, as I look at a lot of our dedicated last year, even with the year that we had, nothing that any of us are pleased with, the dedicated side operated, excluding some that we didn't have the P&Ls on, but the dedicated side, it operated very strongly, and a lot, I would say about half of the fleet on dedicated operated very strongly. The warehousing was absolutely good. The team was absolutely good. And the brokerage performed the way that we wanted the brokerage to perform. So we're going to continue to grow that. Expedited will find its place of where it's supposed to be. Maybe it's 1,100 trucks. Right now it's 13. Now we're saying a couple of hundred to take out of there on the highway services. And let's say that it runs 1,100 trucks and that it is just pumping. It's just pumping, but it's always going to have that. Whether we can get it down to our goal internally is to get that from 83s to 93s instead of 85 to 95, get it 83, 93 ORs, and then it's the 1/3 of your business, and you're growing this other one that's got consistent earnings. So that is what we've been working on for the last 2 years, and I really believe that after we get past the first couple of quarters this year, because of the first 2 quarters last year being year over year, performance better before the world started coming down the second half. I think the second half of this year that we're going to start seeing that coming to fruition for us. That's a long answer, and I don't even know if I answered your question, but I guarantee I answered a lot of people's questions.
That's okay. Are there any – there's been comments about the diminution in capacity. Have you seen that in the long-haul expedited team business also, or has that largely been elsewhere?
Yeah, you have seen some of that, but, as you know, Nick, after you get past 3 or 4 carriers, big carriers, us, CRST, some Warner, U.S. Express, when you get past 3 or 4 major carriers, it becomes people running 1,500 trucks. Instead, this 11,000 trucking company is operating a 29 number 20. Some of those were those 50 truck operations that were running some teams, and so we have felt some of that also. It's one of the reasons why I guess we start out the first 3 weeks of January feeling a little bit better.
Mm-hmm. I'm just curious, if you were to look conceptually at where your mix is today, and you've commented how it'll shift between now and June, but I'd be curious to know, how do you see it shifting over the next 2 to 3 years? In other words, if roughly expedited, I'm using trucks as a surrogate, and it may not be perfect. Maybe by revenues it's slightly higher. But if expedited is a third of your business and reefer is going from 10 to 5, roughly, the balance being simplistically dedicated, how do you see that shifting over the next 3 years? Does expedited become even smaller?
Yeah, well, it will, yes. I think that it stays in that, let's say right now it's 1,300 on what we call highway services. But I think that it gets into that 1,100 truck operation, and our goal is to, run that thing 83, 93 ORs is our goal, and just print cash when you can print the cash during that model and grow around it, and it will continue to be a smaller piece of the pie. That is our plan. Not that it's not important, it's critical, because I'm going to hear, when you pump 83s, none of our other divisions are pumping 83s. So when it's running like that, it can really do extremely well. But we want to grow these other ones that got the solid earnings of consistency.
Yeah, Nick, the revenues were about 40% for that irregular route piece of our business total across all trucking. And we think that over a 3-year period, that'll be down about a third and go around that with advanced transportation and warehousing pieces of our business.
Okay. And is that refers like the down 5% in your model that you're talking about?
Yeah, that's pretty close.
Yeah, okay. So literally you're going to be roughly 60% dedicated, which really in many respects changes the model, obviously, you know better than I do, changes the model of the business. It moderates the downside, but you still capture the upside and improve rates with volume in the highway business. I mean, that's sort of conceptually the way I think you're heading from a financial model standpoint.
That's the strategy to reduce the financial volatility that we've experienced, which we still experience greatly this year, as we still have a lot of work to do on that.
And, you know, and we really felt like, folks, if y'all remember, you know, Richard and I mean, we really felt like we hadn't got into this recession. I think it showed some of it even, but we really felt like a year, 12 months, 14, 15 months ago, we felt like that we had reached a lot of that. We really did. And then the recession hit, and we realized that some of the dedicated trucks that we were operating in were not performing as well as we had. We came out of 18, the best year of our history of our company, and Expedited was blowing and doing extremely well, and we brought on a lot of dedicated. And I would say of those 900 trucks that we brought on, I think about 400 of them would be ones that none of us in this room or on this phone would be pleased with. Not necessarily that some are operating at a losses, but they would be operating in the high 90s to low 100s. And those are the ones that now we've identified, and I really think, or we're close to identifying. I think it's 150 to 200 trucks that we got to deal with. But once we get that solid, as I think about first quarter last year, you know, it was still our third best quarter in the history of our company, if I remember correctly, Richard.
Third best first quarter.
Okay, yeah, that's what I meant. Sorry. Third best first quarter last year until the recession started hitting. And once it stabilizes and business comes back better, I think the work that we've been doing for 2 years and the acquisition of land there, I think it starts showing itself.
So to sum up, David, just very simplistically, what I think I hear you saying is the repositioning of the company and the focus on the balance sheet suggests that you reduce over time, if it's a successful strategy, you reduce volatility, enhance cash flow, reduce leverage, and ultimately end up in 3 to maybe it's 4 or 5 years with really a much different business model than you had here before.
Yes.
That's what
I 100% agree with that, and I think instead of 3 or 4, I think it's a couple.
Right.
I think we're on the cusp of getting there. I really do.
I appreciate it. Thank you. The implications to valuation are pretty obvious when one looks at the way, you know, an Old Dominion, for example, which is not in your business, I'm not understanding, or a Knight get valued, and how different models of revenue models are rewarded in the marketplace. That's the concept I'm trying to understand better. Thank you for your answering.
Thanks, Nick.
Thank you. Our next question comes from Barry Haynes with Sage Asset Management.
Thanks, guys. Just had a quick question. Richard, I think you mentioned that the fleet age at the end of the year was about 2 years. With the reduced CapEx you alluded to in 2020, approximately what would the fleet age pencil out to at the end of the year and then 2020? Thank you.
Yeah, at the end of 2020, I expect that to be closer to 2.2 to 2.3 years. Still very young.
Yeah, sounds great. Thanks very much.
Thank you, Harry.
Thank you. And our next question comes from Jack Atkins with Stephens Inc.
Hey, thanks, guys. Just one quick follow-up question. Richard, you know, the tax rate in 2019, was around 20% on a consolidated basis adjusted. Could you kind of talk about some of the puts and takes for 2020? Would you expect tax rate to kind of bump back up to something more normalized like 26, 27%, or should we expect something lower than that?
Yeah, I think on an effective tax rate basis, the annual ended up being about 29%, but that included the reversal of the federal income tax credit that we had taken. So we pulled that out and we adjusted earnings for Q3 and for the full year. And looking forward this year, part of what was reduced in the fourth quarter on a tax rate basis was when we remeasured our state effective rate, it would reduce by about 2 percentage points. A lot of that has to do with apportionment of where we run and where our revenues come from. And we have had more of our revenues and income in the states that have lower income tax rates. So as we've grown with the land air side and the contract side, we've been able to grow that, outside of the West Coast and Northeast and other states where there's higher tax rates. So I expect the tax rate this year to be anywhere between 25.5% and 27% kind of percent. So appreciate the question.
Okay, great. Thanks very much.
Thanks, Jack.
Thank you. And we have no further questions in the queue at this time.
All right. Well, thank you, everyone, for calling in. We'll talk to you next quarter.
Ladies and gentlemen, this concludes today's conference. You may now disconnect.